Throw it open to the floor and robust questions from inquisitive minds. That's you. Anyone want to go first? Oh. Yes, over here.
For Stefan, just a question about the announcement on Monday regarding these public-private partnerships. Obviously, the investor side of the equation was enthusiastic and the market rose. My question is there any indication that the banks are in any better position as sellers to take the kinds of losses that may result from selling assets into these public-private partnerships?
Well, I think the jury's still out on that. It's a very recent announcement, and it'll take a while to see where the chips fall. I do think that the potential for some of the investor backlash from the AIG bonus flap is possibly going to have an effect on your question, because there could be hesitation on the part of investors to get involved. If the investors don't get involved, the investors that have the capital and would need to be involved to make the program a success, if they don't get involved because they're fearful of government interference with their operations moving forward, that could have a very negative effect on the ability of the plan to be successful, which would then obviously affect the banks themselves.
If I can just jump in on that question, part of the same issue is what is going to induce the banks to participate. As the plan stands now, my understanding of it is that a bank can throw in a portfolio of assets to be bid upon, and if it doesn't like the bids, it can turn its nose up on those and walk away. Well, what is the penalty, if any, on the bank for refusing a bid pool of, say, 4 good faith bids? Can they refuse to play, or does that bidding process establish a mark the next time the examiners are in that bank, where they perhaps ask the bank to mark that same pool down to the bid price, or defend not marking it down to the bid price? That alone may induce some banks not to play. The other facet of that question is, what about banks where we, the taxpayers, already have a controlling or a significant equity interest? How do we, as taxpayers, as shareholders, exercise influence over management to make sure that they participate in this bidding process? So, a lot of detail on the bank side of that is yet to come out. Question over here.
Professor Frankel, when you surveyed the history of Ponzi cases, or the recent history, is there any common regulatory or legal miss that occurs? And if you're looking at what we have now, you're always going to have Ponzi cases, I guess, but is there any regulatory or legal fix that would diminish the chance of that sort of thing happening again, or a made-up thing happening again?
Have less bubbles.
No,
but that's,
yeah.
I'm not joking,
Yeah.
because it's the bubble that creates a longer Ponzi scheme. And that is why we've had, I think, this kind of scheme. The other, to some extent, is educating the investors. However, that education tells the investors, don't trust. The brokers don't trust. The managers don't trust mutual funds. Well, the financial system is based on trust. Otherwise, why would I give my money to anyone? I'll put it under the mattress, or buy some gold, or do some other things, yes? So it goes against this education. We call it education, but it's really mistrust. And that leads me to regulation. I think that the SEC was not very efficient in looking at Mr. Madden. But it is hard when you have, and here, please forgive me, it's hard when you have 3 commissioners who want to undermine their own, the SEC's own rules, who tell the staff not to bring any action before they review it, which takes a long time. You know, we need some vacation, we need other things. So the answer is to be more vigilant, but from the top down, not only the staff. Both of these things may help. Last thing, excuse me for saying that, but I think we haven't looked enough into bubbles. And the way to do it is not to regulate them. We don't know whether they are good for, whether they come because of the economy or they come because it's empty. But we have to have much more examination. We have to have a police on the beat with a baton, not with a shotgun. That's a big difference. We didn't have that.
Yes, over here.
Dr. Frankel, picking up on that, the bubbles are one thing, but has anybody addressed the issue of monopolies or any antitrust issues that might go hand in hand with that?
Look, we started, you're going into, and please forgive me, but I must answer that. We've had an increase in private power. That's why I wanted to ask, when we talk about banks, never mind about the banks, who are the people? Whom do we really, when you say banks don't want to do that, but want to do that, who is the bank? These are people. In 1930, we have limited private power by function. We had this kind of bank, and so on. We've had antitrust. We have eliminated all of that, slowly but surely, in the last 30 or 40 years. And we haven't created something to counteract that. So the answer is yes, we should, and there is a real question on how to do that. I'm not sure that we should do it by function. Maybe we should find another way to create a constitution of the financial institutions. Yes, yes.
The outrage over the unregulated nature of hedge funds and private equity has kind of diminished since this private-public partnership came up. Is it going to be possible to regulate hedge funds and private equity if we need them to take these toxic assets off the bank?
Let me make something clear. Hedge funds have existed from day one, from 1940, and we want them. They are the mavericks. They are those who experiment, who do all sorts of things that nobody else thought about. We like to have this kind of institution. But they were small. And so long as they were small, they were very beneficial. It is when they became, again, when they had a real impact on the financial system that we have the problem. And so, again, it's a question of size and the question of concentration of power more than anything else. Did I answer?
Actually, I'd like to ask a question. Have you seen examples of very large, complicated Ponzi schemes being executed by a single individual without assistance from people that were close to him or her? Are there other examples of that occurring?
Well, Charles Ponzi had a scheme which enabled him to get $15 million in 1921, 22. Well, it's not billions, but it was quite a bit. He did it alone. However, he had feeders. He acquired controlling interest in the bank. not in a very interesting way, but he can. So the answer is, I think it is usually, from what I've seen, usually either one or very small group of people, but a lot of support, and the main support comes from the investors themselves. They are the best sales force. Cheap, not cheap, for nothing, yes? And they bring in the money. Yes.
What's on the other side of that coin, I've seen some of the Madoff statements, and they're very detailed, the monthly statements he put out in the world.
Right.
Quite a bit of activity. And
Yeah.
those statements in turn get delivered to customers and to professionals and to auditors and so forth. And they all sort of tie. So there's quite a bit of work that went into just sort of camouflaging
Wait,
what he was doing.
I testified together with one of the victims, and what he said is that he took those very detailed statements and compared them to the statements in the newspapers, and they were precisely the same. You know why? Because it took only one person to take the newspaper and to copy those statements, and they were precisely the same. They were
price of security.
copies. What he never invested in that. He just sent the copies.
No, my point is to get someone to manufacture the trades, however hypothetically it worked. Took a little work every month. I don't think it's a one.
He didn't manufacture work. He didn't.
He had to show
trade.
money in and out.
Well, but not from the same investments. The investments were copies from a newspaper. I can do that for you anytime. There was no trade.
Understood.
But
You know, a typical audit will go to the third-party custodian, not through the principal.
Correct.
And ask the third-party custodian without asking the principal to validate what is there.
I agree they were fictitious trades. My point is that the paperwork, to develop the paperwork every month was quite a project. I'll give you an example. Brad Blight operated a Ponzi scheme locally here.
Okay.
And what he would do, and it was a rather small one, he only stole $23 million, but he would go in on the weekends, and he would use the systems that, for the bona fide customers, the real investment program that he was running, and he would hand manufacture the statements every month. It was quite a bit of work. The level of Madoff's fraud is much bigger. And so I think Stefan's comment was, can you do it alone? The promoters and the feeders can help you do it by yourself, but to do the bookkeeping for is quite a job. And I don't know if I agree that it's a one-man job. You just pull it off the newspaper.
I really don't know, though, that he had three accountants who didn't have much accounting background.
In the office next to the dentist and the strip mall.
And maybe they help.
I have
don't
relative
know.
confidence that some of the enforcement agencies would like to find nothing more than those other parties that were helping to gin up these statements. And I suspect that whether they were creating the statements or just were on the scene and knew, a la the family and the extended family, there's
Right.
a lot more to come on this story. Let me just ask a question of the group assembled here. How many people know someone who was impacted by the Madoff Ponzi scheme? And myself.
People that were impacted.
Yeah. So that's not exactly a statistically valid sample, but it's about a third, I guess. Yeah. Alan, I have a question for you. And I'm sorry, you have a question back there too. I understand the notion that we have to be ready for the rebound because when people start buying cars again, they're going to do it in a rush. I heard the statistic the other day, I might have mentioned it here, that at the rate people are buying cars today or not buying cars today, it assumes that the life of each car is something on the order of 25 years, right? Now, as miraculous as our...
Call them antiques after 25, officially. Yeah.
So, you know, when the bell does go off, there probably will be a rush. What do we do? What specifically are your companies doing to get ready for that eventuality?
Well, we don't really think there will be a rush. We think, as it was in the early 90s, when we came out of a very difficult period also. It was a slower rebound. It was a strong rebound in the financial sector in the early 90s. But in terms of employment and generally in the population having the money, that was a 2 or 3 year growth period because, as you remember back there, we talked about a jobless recovery. And the feeling is that we will have a relatively jobless recovery in the early part. I mean, the good news would be that there are a number of companies that have reserves, that have cash, but they're reluctant to use it to the point that was made about all companies borrow, and they do, because borrowing is less expensive than using the money they have. They can get more productivity out of the money they have usually. That's not necessarily the case today because of the uncertainty that's going on. And there are a number of companies that are hunkering down a bit, even though they could be more aggressive, because they're waiting to see what happens. And in terms of hiring people, getting those folks back in, creating more job vacancies, that won't happen quickly. I mean, it'll happen over a period of time. So the companies aren't necessarily bracing themselves or building inventory for a quick change. Matter of fact, they're not building inventory, is what the story is.
Okay, great. Question here?
Professor Frankel, you said earlier that you can't regulate a bubble, but I was thinking that a big part of the bubble was caused by rating agencies not properly doing their jobs and not really making people aware of the risks and what they were investing in. How much will the SEC's new conflicts rules for rating agencies help prevent a future bubble?
Well, first of all, much of the bubble started, or at least was, with Fannie Mae, Freddie Mac, and also Ginnie Mae. Not so much Ginnie Mae. So they held an enormous amount of these loans that were not good. I'm not sure that the regulation are going to resolve the problem, so long as we have the three of them and we call them a market. What has happened throughout the years, as I understand it, is that if there was a good rating agency and they started, they were swallowed up, they were acquired. Again, they were acquired by the three big ones, yes? And in addition, the rules gave these three big ones a monopoly, yes? There are some rules that required, that was eliminated now, but that required these ratings, and there are still some rules that require it. So I think we have to revamp that system altogether. There's one more thing. In securitization, the SEC has given an exemption, 3A7, Rule 3A7, to what is called the SPV, that unit through which the loans go in and securities come out. That exemption was necessary, but as a result of it, that exemption was not followed, and what was created were tremendously complicated funds of funds of funds of funds, which made it very difficult to find out anything. This would not have happened if a section in the Investment Company Act would have applied, because funds of funds are very limited. So the answer I have is, when you give an exemption, you should follow it very closely and find out how it is being used, and not say, okay, this law doesn't apply to you, adios. That is not very good. This is another issue.
I have a rhetorical question to more or less try to answer your question, and I throw it out for the group. Having read many of the reform proposals that have been put forward for regulating in the new era, all of them speak about the credit rating agencies. And they all get to this issue of the conflict of interest. And without exception, they all say words to the effect that these conflicts of interest have to be, quote, managed better. Not eliminated, but managed better. And my rhetorical question is, why can't we start off with the proposition being that the very conflicts of interest that are the heart of the issue of your question, why can't we start off with the proposition that they should be eliminated and only allowed on an exception basis? But for some reason, there seems to be a consensus around the notion that we have to manage them rather than eliminate them, but that's just me.
The problem is, who's going to pay the fee?
Well, that's the heart of the conflict.
Right, it's the issuer who has the money, who has the interest in getting derated. Who's going to pay for it if you try to eliminate that conflict?
Well, part of the same problem is that the ratings are mandated by law. You know, in so many instances, whether it's a bank investment or a pension fund or a municipality investing, that since we've already mandated it into law, we've given a franchise to 3 companies, essentially. So why should we, in addition to mandating a business, tolerate conflicts of interest? Wouldn't the market come up with some pricing mechanism for these ratings? There used to be credit analysts, you know, I mean, and stock analysts, and you know, just a question. You've already gone once, so we're going to ask over
Quick
here.
question: is a rating agency something that the government should be doing instead? Is it something that taxpayer dollars should fund so that that conflict is removed?
You mean nationalized rating agencies? Well, that gets a little dicey.
Yeah.
It
But
gets
that's-
dicey because then the government will be the judge of the price. The government will then manage the market. And that's the one thing we don't want to happen. That's one of the problems of rating agencies. We assume that 100,000 million people, when they decide on a price, they come with the best price. Now you begin to shrink it and you come with 3. That's not the market price at all. And now you want 1.
The other conflict that has been prevalent through this recent era has been the rating agencies acting as consultant to the issuer, helping them navigate the very metrics that they are going to come in behind and then judge. Well, I mean, talk about a conflict. That's conflict to the exponent. Over here.
Yeah, I mean, I guess it's very hard to say you're not going to have any conflicts. As Professor Frankel can attest, the 40s Act is a whole exercise in managing conflicts. There's an inherent conflict between the sponsor of a fund and its investors. So it's you know, a detailed set of rules that have been carefully designed to try and balance those conflicts and make the whole scheme work, which it did. I mean, mutual funds worked during this period of time. All the problems that we're seeing now were the ones that occurred before the 40s Act was adopted, and it was designed to prevent. It's just that this one exception for sort of private funds between you and a few friends exploded into, you know, funds that were worth billions and billions of dollars that came outside the 40s Act protections.
It's statistically improbable that all of the inquisitive people would sit on the left side of the room. Non-inquisitive people over here, so I'm going to turn to this group.
Statistics could lie.
Well, apparently. There
There
we go.
I want to ask a question. I'll add to that discussion. Throughout most of our modern financial history, the government has done the ratings. The government has done those ratings through the federal bank examination process, where before securitization and the bulk of commercial credit was done through the banks, it was the Federal Reserve and the Comptroller of Currency that rated those loans. And then, based on the rating, required a reserve against those loans. And that whole scheme has been sort of watered down as the policy bias, first of all, went towards the rating agencies. And number two, the institutions themselves outsourced the rating function, i.e. they got away on the cheap by abolishing their own internal rating agencies. And therefore, the rating agencies inherited, one way or another, 90% of the business. And that wasn't too bad until a third rating agency came into the business. And it was the addition of the third rating agency, Fitch, that then introduced competition within the rating agencies. And it was that competition within the rating agencies that then you started to see a deterioration in the rating process. I think if you look at what's being discussed not only in Washington but in Europe, it is a matter of managing the conflict, but with some kind of trust but verify function coming from the government over the integrity of the rating agencies. So in essence, rating agencies will be examined, if you will, in the same way that the banks are examined, and I wouldn't be surprised to see one of the federal banking agencies become the examiner of the rating agencies in the United States.
This question is more for Stefan, but it seems to me that this public-private venture to get these CDOs off the books, these toxic assets, really is putting the cart in front of the horse. And I'm wondering what's going on with not only the grading, but also with mark-to-market. Because if I'm a savvy banker, and I want to get rid of my worst CDOs, and I want to put them out to this public-private, but I want to hold on to my best CDOs that are paying intrinsically, then the market is going to put a lower price on my worst CDOs, but then I'm going to have to mark all my good CDOs down to the level of the bad ones that I'm putting out. So I might put out 4 bad ones and then a good one to raise the price of what I have internally. But I guess the question is, what are we doing with actually changing the grading of these CDOs from the previous gradings, right? Are we doing anything to look at how to really get the internals of these things down and put a good grade on them and change them from A to AAA, you know, whatever the system might be? And what are they looking at with mark-to-market to give some incentive out there that we can shift some of the bad away and keep the good? And, you know, I think the banks want to keep the good, right? Mm-hmm. And they want to be able to raise the price and then say, we have a better price, right? So they can lend on these larger assets. And I guess I'm asking, with all 3 of those pieces in play, you know, what's happening?
You know, I haven't seen anything yet on either of the 2 issues that you're talking about, but Con, do you have any comments on that?
You focus right in on the heart of the problem. As I understand it, these assets are being carried by those banks that have written them down at all to 70 cents on the dollar, say. And buyers in the market would pay 20 cents on the dollar all day long. But that leaves you with a yawning gap. And what this FDIC guarantee and the use of the TARP is designed to do is narrow that gap somewhat. That's why my opening question was, what's going to force the banks to play? If the whole idea of this is to get these assets off of the balance sheets of the banks, what's going to make them take the leap into that 50% gap, which, oh, by the way, might be the very write-down that erodes their capital beyond repair, you know, particularly in an era when there are precious few, or if any, other alternatives in the marketplace for private capital. So that's the heart of the question. I wish I had the answer, but that is it, as I see it.
Yeah, I mean, it seems to me this whole thing is just like one big experiment in terms of we know how to resolve troubled banks. I mean, we know how to deal with troubled banks. We've done it many times. You know, you have the FDIC. They come in, they decide how they're going to liquidate them, and you know spin off a good bank if you can, and it's done. You know, people know how to do that. So it seems like this is another way of sort of pushing out the day of reckoning. And let's try this one more thing, and it might work, you know, and we won't have to face that day of pain, but if it doesn't, then it could be worse.
Yeah. but it is in the name of time.
Right.
Everyone agrees that the sooner we get these assets off of the balance sheets, then the sooner banks can return to normal lending. But that doesn't mean they go away by any stretch. It just means there's somewhere else to be dealt with. It's the amazing thing to me, just an editorial comment, is that we spent the better part of 2 decades listening to Alan Greenspan tell us and convince us how the risks had been distributed outside the banking system, so there was nothing to worry about anymore, right? Remember those refrains, congressional testimony, the whole thing? It's even in his book. Yeah, right. Well, guess what? One true.
One issue, and that is, how do we close the gap between the price the banks want and the price the government may offer? Let's not forget, there's a couple of hundred federal bank examiners doing stress tests right now in the top 9 banks. The CEOs of those 9 banks have been invited to Washington Friday to meet with the president. And if there's a difference between what the banker's view is and what the Treasury's view is, the bank examiners can close that view very easily during the stress test, because they'll take a view as to what these things are worth and charge it off. So one way or another, the banks are going to incur the hit. So, and in fact, the examiners may even incentivize banks to participate in the partnership, because you're going to lose your money anyway. And so I think we'll follow the stream of these stress tests, which are due to be finished beginning the first week in April, no later than the second week in April. Because out of those stress tests will come values that will, in essence, mark down some of these assets, which will make them more marketable in terms of this partnership.
Can I just elaborate on, or editorialize on the source of that comment? Yesterday in London, an organization unveiled a book that was published yesterday. And it's the short memoirs of many bankers who lived through crises past. And one of the contributors was the gentleman you just heard from, Bob Bench, who spent 20 years as an examiner. So he knows a little bit about what he's talking about. What he won't want to hear me say is the title of that book was Grumpy Old Bankers. And it's a wealth of insights of people who really know what they're talking about. Yes?
Oh, I was just going to ask, it seems like the issue, going back to 4 weeks ago when we were in this room, we talked about the issue was pricing. And going back to all the discussion we've had here, if the FDIC comes in and says during the stress test, it's 50 cents on the dollar, the bank wants 70 cents on the dollar, but they go into bidding and they're only getting 30 cents to the dollar, then aren't they really incentivized to wait until the stress test charges it off at the FDIC price, because they're actually going to get a better pricing through the FDIC than if they go through the bid process?
I suppose, but even then they would be taking a considerable write-down on it, so it'd be getting closer to reality.
But at what point do they take that risk when they also have a fiduciary responsibility to their stockholders? And so it seems they're going to have trouble taking that 20 cents on the dollar when they go into the bank to the bidding process. If they might get 50 cents from the FDIC write-down, where they really want 70 cents, that's still a 20-cent gap instead of a 50-cent gap.
This is the point that the Vikram Pandit, the chief executive of Citigroup, has made. I have a fiduciary duty to my shareholders, therefore I can't sell it for any less than what I'm carrying it for. But as Bob was pointing out, if you can validate that number, and oh, by the way, the FASB is momentarily coming out with new guidance on mark-to-market accounting, as I understand it, which will, by all accounts, be more permissive in using cash flows as opposed to market prices to value these assets. And regulators have already gone to considerable lengths in allowing banks to carry assets at higher values based upon their internal models, which have been getting more and more exacting with each quarter. But I think we're reaching the breaking point where the fiduciary duty to shareholders argument really doesn't carry that much weight anymore, particularly when your shareholders, 36% of them are the taxpayers, and you as a chartered institution are not fulfilling the function that you as a bank were created to fulfill in the economy. So that's going to be a harder case to make, I think, the longer this thing goes on, that to justify the gap. Anybody else? Yes.
I was just going to point, were you saying they're going to offer more guidance than they've currently posted for comment? They have posted 2.
That's my understanding based upon the last week. Can anybody elaborate?
FPs, I guess. They posted 2 FPs.
Yeah, I know there's a considerable degree of relief mixed with anticipation in the banking industry over the new guidance that's supposed to be forthcoming, because on the presumption that it's going to be more liberal in terms of valuing assets.
Right, but there is new guidance that just came out, and it's not all that liberalizing, I guess. I think they would be pretty disappointed if that's all that comes out.
Oh, and when did that come out?
Oh, a couple weeks ago, a week ago.
Yeah, I think.
You're expecting more than that, I guess?
Yeah, help me out. I think there were hearings on this just in the last week.
Yeah, these came out right after the hearings.
Yeah.
But they're not big needle movers.
Yeah. Well, maybe the anticipation is not that justified. Right. Okay. All right. Running out of time. Good. Not good. Listen, thank you very much. I've neglected to mention that Stefan Jouret, in addition to his other life, is the co-chair of the Banking and Financial Law Committee of the Boston Bar Association, along with Nancy Wilsker. And again, we owe a great debt of thanks for the room and for the lunch and for the hostessing of this event. We will meet back here in 2 weeks when 2 of our presenters will be number 1, Nani Burns. Susan Donegan, are you still here? Was instrumental in getting Commissioner Burns, the Massachusetts Commissioner of Insurance, to talk to us, not about automobile rates, but there are some major issues going on in the world of insurance, not the least of which were discussed at hearings yesterday in Washington about how do you resolve on a more thoughtful basis the likes of an AIG, you may have heard of that company, and how do we change the whole resolution process for non-banks. Also, we'll be hearing from a senior executive at Boston Private Bank. So it'll be a busy 2 weeks, I know. Thank you all again for coming. Thank you, Nancy, for hosting, and we look forward to seeing you in 2 weeks. Oh, by the way, the session after that on April 22nd, we are looking for a home because this room is being used. So if anybody has a meeting room that we can take over for an hour and a half at lunchtime on April 22nd, we'd welcome that greatly. Thank you.